Some of the money for this event went into gold and silver, and you see that on the chart. And that's the most positive thing. Ladies and gentlemen, in case you were wondering, the world still sees gold and silver as being valuable, and they still want to hold gold and silver during times of stress. Everybody, this is Rob Keens with goldsilverpros.com, here to bring you your weekly market wrap up. There's a lot of data to get to, and we're going to do a little bit of year in review as well. So let's go ahead and get it started. Gold, as of the time of this recording at 8 a.m. on December 23rd, 2022, is trading at about 1,793. It's come down a little bit the last couple of days, although it's still trading healthy on the week. Silver's at $23.60. Going over this week's major economic news. On Monday, we got a report on the NAHB Home Builders Index at a 31. That index measures the health of home builders and their activity in the marketplace. It came in at a 31 print. The median forecast of economists this month was a 34, and previously come in 33. So both below expectations and below last month. So we've had a slowdown in home building. We're going to see more home data this week as well. The next one up is building permits at 1.34 million, substantially under last month at 1.51 million, and substantially under expectations of 1.48. Again, continued weakness in the housing sector, something that we've been reporting on for the last few months. Housing starts at 1.43 million, actually came in the same as last month and slightly above expectations of 1.4. So there are some starts coming, although building permits have to come before the starts. And if that's any indication, future starts should continue to fall as well, as building permits are much lower than expected. Consumer confidence index is up. It's at 108.3, above expectations of 101.2. That makes a lot of sense because we're in the holiday shopping season. I would expect to see higher consumer confidence as people are buying for the holiday season. Existing holiday sales seem to be okay based upon early reports. We still have a lot of data to look at, see whether the consumer has returned and can save the economy for the year. We won't have all of that data, but we will right now, but we will cover it as it comes out. More housing data, existing home sales lower at 4.09 million on expectations of 4.17. Again, housing data relatively weak to continue to trend in the last few months and end out the year. Jobless claims are about what people expected, 216,000, slightly less than the 220. Continuing jobless claims continue to be high and sticky at 1.67 million. Real gross domestic product revision came in at 3.2%. So the holiday season definitely has GDP up, which is something we expected. How much, we'll have to see the data, and we'll report that as soon as it comes out, probably early February. Also, inflation tends to be sticky. The PCE price index year over year is 5.5%. Core PCE came in at 0.2. Core PCE price index 4.7, slightly above expectations, but lower than last month. So we see inflation moderating, although still high. And I think our call that we're heading into a deflationary mini cycle, leading to another stronger inflationary cycle, it seems to be holding true. We do have inflation, but it's come down, and the economic activity has come down as well as sales of big ticket items like houses and cars are coming down as well. So all of this deflationary pressure in the economy seems to be coming to fruition. Next week, we do not have a lot of economic data. We only have a couple of things coming out. Very importantly, we have the S&P Case-Shiller U.S. Home Price Index, which will tell us where home prices are going. Last month, it was down 8.7%. We'll see if home prices across the United States continue to fall, and that'll be a big indication on the top end of the economy. Again, big purchases, homes and autos weakening, which is an indication we're heading into a recession. Looking at the stock market right now, the Dow is trading up 27 points. In early trading on the day, it's at 33,237. S&P is down slightly, only a quarter of a point, minuscule amount, to trade at 38.49 even. The NASDAQ is down $4.75 to trade at 11,049.50. As we look at the rest of the markets and the cryptocurrency complex, Bitcoin is trading up $60.37 to 16,826.53. Definitely down for the year. We'll get into that in our year-end review here in a moment. Ethereum is also up $4.66 to trade at 1219.61. Litecoin is trading at 65.58, down 15 cents. XRP trading at 35 cents, which is unchanged. And overall, the crypto complex is still very down for the year, but slightly up in the last few days. A little bit of green shoot for the cryptos there. The entire complex of the bond market is in inversion, meaning the benchmark 10-year trading at 3.736%. That has come up slightly on the day, 0.065%, although it's down from where we saw it even just a month ago. So a little bit of less frothiness in the 10-year, although every shorter term issuance, including the 7, the 5, the 3, the 2, the 1, the 6-month, 4-month, 3-month, and 1-month, are all, well, except for the 1-month, are all trading at a higher rate than the 10-year. The 1-month has come down to 3.676%. So to end the year for the next 30 days, I think that people see no recession likely. Although when you get out to any time frame longer than that, 90 days, 120 days, 6 months, a year, people expect recession. That's why those bond rates are higher than the benchmark 10-year. So again, the yield curve is indicating to us that we have an oncoming recession. And as interest rates continue to stay up on bonds, that's not good for existing bondholders because it lowers your face value of that for if you wanted to sell into the market. So we continue to watch the health of the bond market as we go forward. Um, a lot of flight cancellations going on right now. Flight cancellations top 3,000, disrupting Christmas travel. A lot of that has to do with the current weather situation. It's unfortunate this happens every year. It looks like flight cancellations are pretty high. One of the big stories this week was data came out on the flight industry and how we're doing. We have not recovered on flights to pre-COVID levels. We are definitely having issues finding workers for the flight industry. The flight industry itself and analysts do expect flights to start to recover in 2023, heading into 2024, where in 2024 we may actually be at the same levels we were pre-COVID. But a lot of the concern is around whether that industry can really recover, because a lot of people left those jobs, had moved into other industries or retraining. Will they come back, and will the industry be able to recover and handle the demand? That's something that came out in the news this week to see. We think there's some positivity going on in that area of the economy, but we'll have to see what happens. And of course, right at this particular moment, we're dealing with flight cancellations as we see them. That was some of the big news for the week. Going to gold, and we're going to do a share screen here as we go over the CME data, as we typically do. We're going to go over that, and we're going to go over the London data as well, and then we're going to do a little bit of a year-end review as well. So as we look here at the CME Group's website, we're seeing the gold data, which we go over every week. And as we scroll down, we can see fairly light volume. That does not surprise me. We're at the end of the year and at the end of the December contract. Most of the trade has rolled to the next contract month. You're not going to see much to end the year. We'll go ahead and report on it, but I expect volumes to continue to come down. And that's been the trend, as you can see on this chart very clearly. You can just draw a line down beginning through November to the end of the year. People have already made their trades and they moved into the new contract month, which happens to be February, as we can tell by looking at this data. 370,876 contracts closed on yesterday's data. That'd be Thursday's data. We had absolutely zero deliveries. A lot of these contracts are closing for cash or rolling to a new month. We did have some exchange for physical to the London market of 5,065. That's very high. That probably means that people standing for delivery on the February contract are not finding it, and they're going over to London, and or they're just playing price arbitrage. But that seems to be a trend in the last couple of years in COMEX, is a lot of interplay between the US and London markets. A lot of speculation why that could be. Maybe we'll cover that in a future episode. I have some ideas. Looking at Wednesday's data, similar pattern, 5,631 exchange for physicals to the London market. On trade is 375,000 contracts. Nice, healthy market. A slow market to end year, but that's what we honestly would expect. Let's go over here and look at the settlement data. This tells us pricing. Again, February 23rd is a dominant contract. Volume as of yesterday's data, this is Thursday's data, you can see up here, is 176,825 contracts of gold, which is nice and healthy, but not the highest you will see it during the year. And it makes sense as people are rolling into the new year. The prices were down about $30 on Thursday trading on the COMEX to settle at around 1795.30. If you look back to Wednesday's data, you'll see a similar trend. in that you had healthy contracts, although the price didn't change that much. It's actually the rare case in which the dominant contract month, the price of gold stayed about the same. And you'll see this unchanged very rarely. On other contract months, up about a dime, nothing really to speak of. If we go back to Tuesday data, it was very bullish. Gold was up 27.70 on Tuesday trading to settle at about 18.25 on the strength of 198,000 contracts. So a little bit of weakness in gold to end the year, but we'll see how gold has done throughout the year, and we'll see it's done pretty well. We'll get to that data in a moment. Going over to the physical, I love this chart from Nick Laird's Gold Charts R Us because it gives us physical statistics on the physical trade across the world, mainly the London market and the U.S. market. The top three lines are primarily the U.S. market. It is the COMEX. And you can see that net we're down about 800,000 ounces of gold stored on the COMEX over the last 4 weeks. This gives us a nice little 4-week trend. What about the London market? As we look at the ETFs, they're down quite a bit less, actually. They have actually added probably about 100,000 ounces of gold across the ETF complex. So gold is about relatively the same flow wise over the last 4 weeks on the major exchanges, although the long term trend is definitely for gold to come out, and we'll show that. We're just going to look here at the GLD. As you go up to the GLD that's run by SPDR, it's the biggest one, as you can tell by total weight. The next one is iShares. We look at the GLD, and you can see the trend since Silver Squeeze February of 2021 has been for gold to come out of the GLD, even though there's been a recent uptick of a little bit of add. It's been a little baby amount, just like a little baby amount. If you want to look at the iShares, we click on this. The trend's been the same on the iShares. Gold has been flowing out with a little bit of recent uptick, but not much. So that gives you an idea of gold stocks around the world. Gold is flowing out of the Western depositories. It's also flowing out of Shanghai. We showed you that on previous episodes. So what that means is people are taking personal physical delivery of their gold, either for industrial purposes or more likely for investment purposes. About 70% of gold is used for jewelry or various forms of investment. And so we expect that people are taking gold position right now physically for what they see as the oncoming recession next year. That seems to be a consistent trend in the gold market. So let's look at silver. You're going to see similar things in silver in terms of not a lot of trade in the current contract month for December. Most of the physical deliveries have been settled. Most of the cash settlement's been done. People are rolling to the next contract month, which in silver is actually in March. And you'll notice that gold and silver only have certain dominant contract months during the year. They each have about 6. December is a common heavy delivery month for gold and silver, but as you get going throughout the year, you'll notice are different. So right now, February is the next big month for gold, whereas for silver, it's March. And that's just the way that these markets trade. People are okay with taking a futures price position until March on silver. And as we look as of yesterday's data, this is as of Thursday's data, 113,000 contracts, 118 traded. There were exchange for physical to London, 475. Overall, only 264 deliveries on December, none on March. We have 467 contracts left open, so we could see an additional 467 physical deliveries, or people could settle for cash or roll out of that position. We'll have to see what happens. That's Thursday's data. If we look back to Wednesday's data and get a refresh, we had 175 exchange for physicals in the London market, 114,000 contracts closing. Pretty healthy market there for March. We look at the settlement data to see where the prices are coming. We see that overall the contracts for the March and yesterday's data settled down about 57 cents net to settle at a price about 23.62 on 47,000 contracts. A fairly light day for silver. 37,000 contracts on the day before on Wednesday's data, as you see up here. Closing at about 24.19, closing down about 77 cents. And if we look at the physical trade at the chart, you can see the COMEX. There's actually been quite a bit of silver flow back into the COMEX on the order of almost 5 million ounces over the last 4 weeks, although that's a drop in the bucket what's come out since Silver Squeeze of February 2021. And we've seen overall 10 million ounces come out. So most of the silver flowing out of the Western complex for silver trade has been flowing out of London. A little bit of it flowed from London, it looks like, or from the world back into the US. So slightly more positive silver inventories in the US. A lot, however, flowing out of London. And that's a lot of the exchange for physical trade. And also people just maybe playing price arbitrage, or maybe there's more liquidity for people willing to deliver silver in London. And that's why most of the drain the last 4 weeks has been from London. As we look specifically at the SLV, That is the largest of the ETFs that stores metal in London. They do store some in New York, but most of that silver's in London. You can see the trend is still down. There's been a little bit coming back in to SLV in London, and it's moderated a bit, but the overall trend is still down. If you look COMEX, it's the same thing. If we look at the most important, the registered category, which is the liquid silver, you're only looking at 36 million ounces out of 300. The rest of this is private storage. So about 263, 64-ish million ounces on COMEX's private storage, which is not liquid on the exchange. People could sell that back to the exchange or make it deliverable on a contract. But that right now, it's privately held. So we look at this as being the liquid silver up here. And if you look at that chart, that has fallen off a cliff. It literally has fallen off a cliff. We had almost 160 million ounces. Now we're down to under 40 million ounces. So the liquid silver on COMEX has fallen off, even though some has come back in, and even though some has come back to COMEX overall. If we look at the total numbers, there's been a little bit of flow back, but it's a baby amount. Look at the baby amount. So I don't want you to be alarmed by the fact that these numbers are green and some silvers come back into COMEX. It's a baby amount considering the mountain of all COMEX silver. And if we look at just the liquid, which we know can be traded right now, that's not owned for some other purpose, it's fallen off a cliff. So when you look at the liquidity of silver on the COMEX, it's low. And if you look at the liquidity on London, it's flowing out. If we look at the next big ETF, the PSLV, it's had some actually increase because that Sprott fund, because there's stronger redemption rights. You've seen some increase where people have redemption rights. Where people don't have redemption rights, you see it flowing out. So a little bit of this flow is into smarter forms of silver investment, ETF investment, that protect your rights. PSLV protects your redemption rights more than SLV. So that's an interesting little interplay going on in that market as well. All right, over to the CFTC COT report. And as you'll know, I'm taking more time on this particular weekly market wrap to discuss what's going on, because this is really sort of the year-end one. We'll do another one next week. It'll be a baby one, but this is a year-end, so I'm putting a little bit more effort into explaining what's going on for this one for you guys to prep you for positioning for next year. All right, so we're sitting on the CFTC COT report. I'm looking at silver, as you can see here. The date is of December 13th. Yes, I realize that's 10 days behind. That's the way the CFTC reports it. So when we're looking at this data, we're actually showing you what led to the price increase or decrease of silver here. All of this is the current data that was representing trades that we see here, if that makes any sense. So we're looking backward at the positioning, which explains the current moves in pricing, if that makes sense. Just the way the data is reported by CFTC. So we kind of have to extrapolate this report and what's happening in the current market data. As we can see here, not a whole lot of change. We did see the producer merchants added 4,000 short contracts in silver and 1,000 longs. These 1,000 longs will mostly be the merchants who are protecting their upward price risk when they use silver and buy silver for their products. The producers will take the shorts, protect against downside price risk for when they produce silver and it's potentially cheaper when they go to market than when they pulled it out of the ground. There's a process there and a time process. So they want to protect their downward price risk. So that makes sense. That's normal. As we look at the swap dealers, not a lot of change. They've dropped some shorts and longs, relatively the same positioning in silver, slightly short, which tells me they expect the price of silver to moderate, and it in fact has been moderating. And that's why I call the swap dealers or the bullion banks the sharp money. They really know what's going on. The managed money is often sort of the dumb money in this trade, although sometimes they do things intelligently. They have gone net long of about 18, 19,000 contracts in silver, which they're really supporting higher silver prices. So we have to give them a hand. I think they figured out they were the dupes in silver for so long, and now they're getting ahead of what they think is going to be a silver rally. Now, silver could have some weakness in the next couple of months, and they could lose money in these positions. But I do think managed money going long indicates that they're looking at silver physical shortages and finally starting to pay attention with that. These two groups, the swap dealers and the managed money, are the ones I'm looking for the silver bull market. If both of those are going to go long, you're going to have a massive silver bull market in the spot price. And when these line up on the same positioning, it's very rare. It's like having a blood moon or an asteroid pass by that you can actually see. It's that rare. And so when you see swap dealers and managed money lining up together, that looks like maybe we're headed for a bull market. But I think in the short time of silver, we could have a little bit of price weakness. And I think the bull market's going to come, but maybe it's still a few months out, something along those lines. The other reportables are just the smart individuals and family offices and people like that. I mean, you can put a movie star in here or somebody that has a bunch of businesses, and this is this type of category. If they're big enough, you can trade on the market as an individual or small business. They're aligned long on silver, which doesn't surprise. As we go to gold, same report time frame, different situation with gold. The swap dealers are decidedly short still. They're keeping gold price down. Whoever's trading through them, their clientele, and plus what they trade for their own house account, they're short almost 101,000 contracts in gold. So they definitely expect continued weakness in the price of gold. Producer merchants, what you would expect. Merchants have 13,000 long contracts, producer 50,000 shorts to protect their exposure to the physical gold price that they use, either producing gold or using gold in end products. That makes sense. Going to the managed money, they've gone decidedly long, about 35 or so thousand contracts, 36,000 contracts. Difference between the long and the shorts, because managed money expects gold to go up. They're looking at what's going on in the economy. And this is something managed money is very good at. They look at economic data. So it does not surprise me they're long gold, but they're the opposite side, the swap dealers, and the swap dealers are almost always going to win this trade in a normal market. And so I expect gold to be moderately weak until the swap dealers start to switch their positions, or everybody outside the swap dealers forces the swap dealers into a short squeeze. If the producer merchants flip long or just add a bunch of longs, and the managed money goes hard long like they are now, but they continue to add, and the wealthy family offices, which are 4-to-1 long, continue to add, it could force the swap dealers into a short squeeze, or the bullion banks a short squeeze position on gold, although we may be lining up for that. We're not quite there yet, but that's something to look for. I'm going to look at the London Vault data. You started to see this roll off in gold. When I first started reporting this data, it was more pronounced in silver. You can definitely see in London all the free silver has been taken off. I mean, we're down now to 140,347 ounces. This amount of silver you see in this bar chart includes all the silver you see here. So all of this ETF silver, if you take it out, what's left over is the free silver, essentially. So there's not as much free silver available now in London because a lot of that's sitting in the ETFs and the rest has come out. And so there's not as much liquid silver in London. There's not as much liquid silver in the COMEX. If you go back to the COMEX and look at silver there, when we look at the liquid silver there, remember that's fallen off. So you've seen this run on silver on the London markets where you're starting to see it in gold. A massive runoff in silver dating back to silver squeeze last year. Now the last few months, people are starting to get into gold. When people start to get into gold, that means we're heading to recession. When people pull it physically from the market, we're heading to recession. People pulled the silver for two reasons. One, you needed it for industry. It's very industrialized commodity, and we needed it for financial investment. So silver came out first. That makes sense. Gold's a little bit less industrialized. It's more as a money, more as a crisis hedge, more as a safe haven. And so you're starting to see that come off. And when you see gold come off the physical exchanges, like it's come off of the COMEX, you can see here it's come off of the COMEX, and you can see here it's coming out of London. That's when you know that you're headed toward recession. People are taking their positions in gold, not only the central banks, but everybody else. And should you, that's the last thing we want to talk about on our year-end review weekly market update. I have plotted gold and silver here on the chart. Gold and silver are represented by gold in dark gray, and then of the rest of the market. So we have the S&P, we have the Dow Jones, we have the NASDAQ, all charted here for you. You can see all those stock markets are down for the year. This is a year-to-date chart dating back to the beginning of 2022. I've chosen 11 months and 30 days. So you're getting actually the last couple of days of 2021 as well. But you see year-to-date, all the major stock market indices down, lines down. All these colors other than gold and silver, down. What about gold and silver? Slightly up. They're going to end the year either even or slightly up. So in a year in which we had financial crises, in a year in which we had new war, in a year in which we had the breakdown of globalization, in a year in which we've had more reports of de-dollarization, in a year in which we're struggling to recover from the pandemic, what did better than anything else in the market? Ladies and gentlemen, it was gold and it was silver. They're going to end the year, this crisis year, up much better than the stock markets or the bond markets. Where do you want to be in times of crises? It's gold and silver. I think that this chart proves that. And it's nice to be able to say that about gold and silver after the last few years. Even though gold has done very well and silver has done pretty well the last few years, it's been criticized heavily. But you see what happens in times of crisis, where people go. They go to gold and silver. Some of the money from this market liquidation went to pay down bad debt, went for margin calls, went for liquidity purposes, cash purposes. Some of the money for this event went into gold and silver, and you see that on the chart. And that's the most positive thing. Ladies and gentlemen, in case you were wondering, the world still sees gold and silver as being valuable, and they still want to hold gold and silver during times of stress. And we believe we're headed, if you listen to all the market analysts in the bank saying we're going to have rolling waves of deflation and inflation and rolling waves of issues. Goldman Sachs and Bank of America and all these banks reporting this, and analysts starting to report it. Even the Fed is saying, hey, we've got some issues with potential recession. We need to tighten. We had to economy. We need to pull it back some, but we're worried about recession. We pull it back too much. Everybody's talking about these recessionary and inflationary waves we're going to have. And I think 2023, looking forward to this year, we're in a bit of a deflationary stage, but we have that triple inflationary pattern that's happened during the Great Depression, happened during the last inflationary issues in the 70s and 80s. We're going to see that again. We're going to see three inflation peaks separated by periods of deflation. We've hit one inflation peak. We got up to over 9%. We're going to now deflate. We've seen that in housing and we've seen that in auto. We haven't seen it in retail because we're in the last quarter of the year during the biggest, Black Fridays to bring companies in the black. It's when consumers do the most spending. So I expect GDP to go up for the fourth quarter, but depending on how much it goes up, when we decrement that for CPI and decrement that for inflation, we're going to see whether we actually move forward or move backwards. And that's going to tell us maybe how bad that recession is going to be starting in 2023. And 2024 may be actually the worst year of all of it. That's what I expect. I expect 2024 to kind of be the worst part of whatever recession we're going to go for. But definitely looking forward to 2023. I expect gold and silver, having done well this year, to moderate just a bit until we see how bad the recession is going to be, and we see the Fed's reaction to that recession, and we see the bond markets and that yield curve inversion. How that goes, I think, will determine how gold and silver are going to go for the rest of the year. So I'm going to take the first quarter and really look at the economic data, and then we're going to see what's going to happen to precious metals for the rest of the year for 2023. So stay tuned to these weekly market wraps, because that's where we look at all of this stuff, and that's where we tell you what's going on in the economy. This also goes out over podcasts. So if you subscribe to Gold Silver Pros on any of the podcast networks, Apple, Google, Spotify, or Anchor, you'll find us there. And if you're just in your car and you want to listen to this, you can do that. As well as coming to the YouTube channel as well. Thank you guys so much for this. This is going to be the last really of the chunky weekly market wraps for the year. We'll come back uh, next week and do one which will be kind of our last year ending one. Won't have a lot of data in it. The markets won't be robust next week because of the holiday. So we'll report what's there. And then we'll come back in 2 weeks and do really the first one of the new year and get into 2023. I think it's going to be a very exciting year. It's going to be a lot of fun. Thank you guys for joining us, supporting JM Bullion and Gold Silver Pros in these weekly market wrap ups. And we'll continue to bring these because we know how valuable they are to you. Until next time, this is Rob Keen's Gold Silver Pros. Have a very merry holiday, a very happy holiday season, and we'll see you as we head into 2023.